On to personal finance. Do you have investments that may have lost value? Well, don't worry, because that could save you money during the next tax season. It's through what's called tax loss harvesting. And here to tell us all about it is 𝗂𝘂 𝗟𝘂, the founder of Mitlin Financial and author of Financial Planning Made Personal. Larry, great to have you with us. Can you explain tax loss harvesting and how it could help one's personal finances?
Yeah, so now that we have tax season 2024 done with, now we have to start focusing on 2025. And sometimes these market gyrations present opportunities that can be extremely helpful. So essentially what you want to do is look through your portfolio and find maybe some of those underperforming securities that may be at a loss currently. And keep in mind, this is just for non-taxable accounts, not retirement accounts. You want to look for those underperforming securities and sell them at a loss. And essentially what that will allow you to do is utilize that loss against gains that you might have during 2025. You just have to stay out of that security for a minimum of 30 days. So on the 31st day, you can essentially buy that security back if you're really confident in it, and still maintain that loss on the books for your 2025 taxes.
Lawrence, what you're saying is exactly right. Thanks for explaining that for us. Now, I want to toss this at you. This is from NerdWallet. They say don't sell your losers, these losing investments, to improve your taxes, because what you want to do is go for that long-term growth. So how do you balance the two?
So I think, yeah, you want to be strategic about it. And just because you want to get that loss doesn't necessarily mean you have to sell it completely. So there's another way that you can go about kind of having your cake and eating it too, so to speak. And what that is if you're really confident in the security, you could buy more, double up. And if you think that you'll still be at a loss 30 days out, you can then sell the original lot that you purchased originally, sell that lot and keep the second lot that you just purchased, and still maintain the loss and not violate what we call the wash sale rule, which would basically eliminate that. So there are ways around it as well.
That is really fascinating. Very strategic moves, definitely something to consider. So how do we rebalance our portfolios in a tax smart way?
So you want to, again, I think that having a professional is very key in this type of situation. But if you want to try to go about it on your own, look at your portfolio and how it's currently balanced. See what kind of losses may exist in the portfolio and perhaps capture those losses. Now, remember, to your point earlier, we're not selling them because we're not confident that they're going to rebound. We're selling them for a tax strategic manner so we can capture that loss. And then if we want to buy it back in 31 days because we're still confident about its long-term features and benefits, we can do that. And essentially, when you sell it and capture that loss, you can also redeploy those assets to another security that's just not exactly like the one you sold.
So if you're investing in an index fund, that may be hard, but if you're doing individual stocks or these exchange traded funds, it might be a little bit easier, right, to do this tax loss harvesting?
It is much easier if you have individual securities to do that with, because one of the things that you want to be careful of is within that 30-day period, purchasing another very similar security. So you can go from, let's say, an S&P 500 fund to maybe an international fund for a short period of time if you wanted to, because they're substantially different. But you could not sell one S&P 500 ETF, let's say, and then go into another version of that S&P 500 ETF and still maintain that loss. So you do have to be strategic and careful at the same time.
Really, really very detailed analysis here, Lawrence. Let's dive into this a little bit further. Robo-investors, those robo-advisors. Maybe some people want more control over their management of their portfolios, but these robo-advisors are like a tax police. They just keep a 24/7 watch, and they're always trying to look for ways to minimize taxes. Do you recommend people may want to give those a chance?
So I would say this, I can't speak for all investment firms or advisors, but some of them will kind of look out for those tax loss opportunities. And I will say that there are many out there that don't. They'll just arbitrarily rebalance portfolios irregardless of what the tax consequences are. We had a real life example with a family that we started working with who was with a robo-advisor that basically she was shifting part of her portfolio there, and they were going to liquidate her entire portfolio and rebalance it, but it was going to incur a substantial capital gain. And this robo-advisor in particular wasn't really cognizant of what the tax consequences are. But you know what? Humans can look at those trades, make sure that the tax effects are going to be positive for you before you do it. I can't say that that's the case in every robo-advisor situation.
Okay, and is there transparency, though, as a follow-up to what you're saying, that will the robo-advisors let you know ahead of time that they do look out for taxes?
Most of them do not. I mean, most of them will not give you a heads up before they place those transactions. You're putting and entrusting your money into their system and their algorithm. So you're basically buying into what their process is. So you have to be very careful and mindful of what that process is and how they actually manage it in practice.
And Larry, I don't expect you to give us advice on managing our portfolios, but with this era of tariffs and this turbulence in the stock market, do you have any catered advice or comments to exactly how people should view that? I mean, there was a big drop, a big gain. There might be some more happening. I mean, we talk about long-term gains. How does this all relate to what you're saying?
So uncertainty is not our friend. Markets can always deal with good news, obviously. They can also deal with bad news, but the thing they can't really operate under is uncertainty. And we've certainly seen a lot of that over the last several weeks. So depending on your situation really depends on how you should be thinking about addressing it, right? In terms of if you still have a long-term time horizon, probably riding this out is going to be just fine. If you look at market history, there has never been any 10-year slice of the market. Well, I should say in every 10-year slice of the market, there's a 97.8% chance of having a positive return by every single 10-year slice. So that shows us that over long periods of time, we'll probably be okay. But be cognizant, if you have a shorter time horizon, you may want to look to adjust your allocation based upon what that time horizon is and where and what is going on at the moment today.
This is very valuable information. We appreciate it. 𝗟ance 𝗟ฑ์, founder of Mitlin Financial and author of Financial Planning Made Personal. Thank you.
Thank you.